Hi everyone, it's Christy and we are here with Facebook Live. We are going to be doing some financing exhibits. Today we are going to start with the conventional loan exhibit and we will be starting that in just a minute. We got about 4 minutes, so I'm going to give a chance for some of our other amazing people to jump on. So I'll give you guys just a second to grab some notes or something to write with, and we'll get started soon. All right, everyone, it looks like we have about 2 more minutes. So we're just giving a chance for everyone to jump on. All right, we are almost there. I know you guys can barely control yourself because it is so exciting to talk about contingencies. I'm just kidding. All right, financing contingencies though. All right, it's 11 o'clock, so let's get started. And I know, please don't be disappointed that you can't see my face today. But I am personally super excited of what's going on, and that you guys can at least, if nothing less, see what's going on. Hopefully on my screen here, because I want to make sure that you have everything available to be able to see. So I want to make sure here, I don't want you to have to see the notes on this, so I want to hide that presenter's view. Let's see. And it comes up saying that it's resuming the slideshow, but unfortunately, every time I look at Facebook, you guys, it looks as if you're seeing like the slides down the side. I didn't want you to see the slides down the side. So let me see if I can get that fixed because I don't want you to see that. Bam. Yet I still think you do, which is kind of crazy. All right. Well, either way, I'm going to try to get things started so that you can see it, and you kind of have to see the notes on the side. That's what I didn't want to show, was the notes on the side. You don't want to see all the presenter stuff. All right, well, we're going to try it one more different way, and then I will just let you guys kind of go from there. And I apologize about that. I wanted it to be where all you saw was the slides. But I guess that's not working, is it? Kind of crazy. Okay. So let's see. We're just going to go with it from this. All right, guys. So financing exhibits, the forms we use, and the representation that it presents. All right. So here's what it is. What is a financing exhibit? Okay. Well, a financial exhibit means the financial planning, accounting, and reporting procedures related to the agreement attached hereto as a financial exhibit. Okay, so the goal in preparing the financing contingency exhibit is to set forth loan requirements that are acceptable to the buyer, but that are also not so restrictive as to give the buyer an automatic or easy way out of the contract. Now, this comes straight from the Red Book of Real Estate Contracts, the 6th edition, 2021. And the financing contingency or financing exhibit allows the buyer to set forth some of the rules to show the seller exactly what they're able to do as far as obtaining a loan. What it also does that most buyers, agents, and listing agents don't realize is it gives the seller some of those responsibilities as well to be able to see what is going on with the loan for the buyer. What I have found out with agents is that most of us don't take the time to actually read what the contingency and what the exhibit says, so that we don't see or we don't hear what exactly the verbiage states for both parties. So that's really what we're going to go into today, because just like the Red Book states, the goal is to set forth the requirements. The goal is to make sure that not only are these requirements acceptable for the buyer, but they're not restrictive so that they can't just jump out of the contract. So you're protecting the buyer and the seller together. All right, so let's talk about that. All right, the ability to obtain a loan. That's the whole purpose of the financing exhibit. The ability to obtain a loan. Now, this is defined in the GAR Conventional Loan Contingency Exhibit, which is what we're talking about today, is being qualified to obtain the loan or loans described in the exhibit based upon the lender's customary and standard underwriting criteria. Now, we're going to talk about it, and especially this is in paragraph number 5. Now, why is it important to understand if the buyer is able to obtain a loan? Okay, why is that important to the buyer? Why is that important for the seller? Right? Well, of course we know why it's important for the seller, right? It's important for the seller because they want to sell their house. So why would we want to have the buyer write a contract to buy a home if they can't buy it? That's just not purposeful for the seller. But of course, why is a buyer going into the trouble of trying to purchase a home if they don't understand the criteria of the underwriter and of the lender? And that's one of the big things that I feel we overlook when we're having this conversation with our buyers, and even when we're having that conversation with the lenders. Do we know what the criteria is for a buyer to obtain a loan? Have we had that conversation with the lender in general, right? Because every lender is different, just like every home purchase is different. So we're going to talk about that. All right, so let's explore. All right, here is the conventional loan exhibit. So it is a 2-page loan exhibit. It is a 2-page loan exhibit pretty much. And we're going to go through each paragraph to really dive into exactly what this says and why this makes a huge big difference for you as an agent to understand it and to be able to explain it to your buyers. And if you're a listing agent, it is more crucial for you to understand it so you can have that conversation with your seller. All right. So I am going to see if it will let me do this and let you see it. Perfect. I think that's better. All right. I think you can see this a little bit better. All right. So let's talk about buyers may apply for a different loan. So I'm going to scroll up on this a little bit so that you can see. Oh, for some reason it didn't move forward on me. Okay, that didn't help you guys out at all, did it? All right, there we go. All right, so the first 2 paragraphs, one talks about the application. So of course that's very simple to know. The buyer shall promptly apply and in good faith to seek and obtain a loan, a conventional loan. So box A and box B talk about the first and second mortgages. Well, that's going to come down to your lender telling you, are they going to get 1 mortgage or 2? Now, in this day and age, most people get 1 mortgage. Okay, so that's your first mortgage. That's where you see right here. Okay, it's also going to be the loan amount. And for those of you who have not done a conventional loan exhibit or any loan exhibits, this is the amount of the purchase price, which means if they're getting a conventional loan, are they putting down 5%, 10%, 20%? So if they're putting down 10%, then they're getting a loan of 90% of the purchase price. Okay. The terms would be for 15 years, 20 years, 30 years, and their interest rate. Their interest rate should also be the one that is coming from their lender. This is not always on their pre-approval or pre-qualification statement, so don't always feel that it is on there. And you do need to have this from the lender to be able to put in here. Now, don't feel that if you put a interest rate in here and it changes that you have to change your whole contract. You do not. We understand that interest rates do change, but you want to be able to put what is one that is standard with the market. Obviously, if we see someone come up with a 12% interest rate, we're going to know that that person probably has not had a conversation with the lender. The interest rate types are fixed, adjustable, and interest only. Most conventional loan are fixed at this point unless they have specialty financing, and they're usually institutional. Institutional loans means that they're getting a loan through a broker, a lender, a bank. Seller is what it is. That's a loan through a seller. Most sellers do not do conventional loans. However, there are always existential circumstances and other. Are they getting this through a third party lender? Are they getting this through a trust or through a different type of loan situation? All right, so that is the first part of your conventional loan contingency exhibit. Now, number 2 says the use of a particular mortgage lender. I didn't highlight this because this is pretty much about as cut and dry as it is. Unless an approved mortgage lender is identified below, the buyer may apply for approval of a loan with an institutional mortgage lender licensed to do business in Georgia, right? if nothing herein shall require buyer to obtain a mortgage financing from an approved mortgage lender. So if they have an approved mortgage lender, you can put that approved mortgage lender in the box. Understand, if you do not put an approved mortgage lender in the box, it is saying that you have to identify one at the point in which the buyer chooses and applies for a mortgage. You can't just not let the seller know who the mortgage lender is. Okay, now box number 3, and here's where we start our enjoyment. All right, a buyer may apply for different loans. All right, and here's where people get a little confused. So we're going to go through this. What does that mean that a buyer can apply for different loans? A loan denial letter, as that term is defined below, and we'll talk about that soon, must be for the loans described above. Buyer may also apply for different conventional loans than the loans described above. Now, when they say different conventional loans, we're going to go back right here. These are conventional loan types. Okay? Conventional loan may be a 30-year loan, a 15-year loan. A conventional loan could be a 80-20 loan, a 90-10. There are 5% conventional loans. There are institutional fixed rate loans, adjustable interest only loans, but they are still conventional loans. Okay? But it says here, however, the denial of such other loans shall not be based for buyer to terminate this agreement. Well, what does that mean? Notwithstanding the above, the buyer shall not have a right to apply for an FHA, VA, or USDA loan unless the parties agree to amend this agreement to an FHA, VA, or USDA loan exhibit, meaning the FHA, VA, or USDA requirements, as the case may be, in which this conventional loan contingency shall no longer be part of this agreement. Nothing herein shall require the seller to agree to amend this agreement. What does that mean? That means that if the buyer decides, after they've submitted this conventional loan exhibit, that they want an FHA loan because they don't want to put down but 3.5%. Good for them. But that doesn't mean that the seller has to agree to continue with the contract if they choose to get an FHA loan. That also doesn't mean that if they are denied an FHA, VA, or USDA loan, that this contract can be terminated. Because the only way this contract can be terminated with a loan denial letter if they are denied for a conventional loan. So make sure you understand that. Okay? The second, number 4, says the buyer to notify the seller of intent to proceed. Okay? When it is known, the buyer shall promptly notify the seller of any mortgage lender to whom the buyer has sent a notice of intent to proceed with the loan application and the name and contact information for the loan originator. Here it is. So your buyer has now chosen that they want to use XYZ lender. So we're gonna pull Jeff and Vinny in this because they're an easy target. So they have decided that they're going to use Vinny for their loan. But for some reason, they didn't know. So you didn't put Vinny up here in the approved lender box. But they've decided that's who they're using. It is your responsibility as the buyer's agent to send a notice of intent to proceed with Vinny's name, contact information, etc. to the listing agent. Okay, that is part of the contract and that is part of this exhibit. Okay, Now, how many times have people failed to do so? Or if you have changed mortgage lenders and the mortgage lender that you have decided to proceed with, or your buyer has decided to proceed with, is not the same as this approved mortgage lender, you have not sent a notice of intent to proceed. That's number 4. You could raise question on the validation of your contract. And the buyer or the seller could question your intent, which means there could be grounds to terminate. We don't want to have any question about that. So let's make sure that we don't leave that up to question. Okay. All right. So we are now number 5, the financing contingency. I love this one because everyone always has wonderful questions. All right. The buyer shall have blank days from the binding agreement date, which is considered the financing contingency period, to determine if the buyer has the ability to obtain the loan described above. The buyer shall be deemed to have the ability to obtain the loan unless prior to the end of the financing contingency period, the buyer A notifies the seller that the buyer is terminating the agreement because the buyer has been turned down for the loan, and B, the buyer provides seller within 7 days of the date of such notice a letter of loan denial from the mortgage lender based upon the mortgage lender's customary and standard underwriting criteria, the loan denial letter. The loan denial letter and mortgage lender issuing the loan denial letter must meet all of the requirements set forth elsewhere in this exhibit. What are the requirements set elsewhere? Well, that would be number 1, approved mortgage lenders. Number 2, the buyer notified the seller of intent to proceed. Notwithstanding any provision on the contrary herein, the loan denial letter may be provided to the seller after the financing contingency period has ended if the above referenced 7-day period to provide the loan denial letter falls outside of the financing contingency period. Now, here's where people get a little wonky. Well, what should my financing contingency period be? Well, question is, have you had the conversation with your buyer if they've even applied for a loan? Have they even had a conversation with a lender? Because they should have already gone through step 1 before you're sitting down to write an offer with them. Right? Because they need to know if they have the ability to obtain a loan before you're questioning financing and a contingency period. The problem is financing contingencies are not about closing the loan. This is, are they qualified to get the loan? Now, it is not your responsibility as an agent to ensure that your buyer doesn't go out and buys a boat. It's not your responsibility to ensure that they do what they're supposed to do. However, it is your responsibility to ensure that they understand what number 5 of the conventional loan exhibit contingency says. And if you put on there 14 days from binding agreement, that means that day 15, it doesn't matter if they go out and buy a boat or that they don't get the right tax documents to Vinny that he has requested for 2 weeks, and now they're denied. There is a very good chance that if they are not approved or they are denied, they will lose their earnest money to the seller. Please make sure that as you are doing a financing contingency of any kind, that you have this conversation with your buyer. It's very important, and it's not difficult. Okay, it's not hard to understand. However, if you don't have the conversation up front, they're not going to understand what it means and why it's important that you do this. The last thing we want is for someone to lose their earnest money when it was avoidable. All right. Now, the fun stuff. Number 8, use of approved mortgage lender and loan denial letter. All right. So the buyer has agreed to apply for the loan with an approved mortgage lender. The loan denial letter must be from an approved mortgage lender. If the buyer is not required to apply for the loan with an approved mortgage lender, the loan denial letter may be from an institutional lender licensed to do business in Georgia. Okay. A loan denial letter from a non-institutional mortgage lender may not be basis for a buyer to terminate this agreement. So my cousin Joe lends money out to people. He can tell me I don't qualify. Does that work? Yep, that's not going to work for you. This has to be from an institutional mortgage lender. Okay, so notwithstanding any provision to the contrary, the loan denial letter may not be based solely upon one or more of the following. Okay, you might want to highlight these for your buyer. The buyer lacking sufficient funds other than the amount of the loan to close. Can't be because you don't have a down payment. That's not a reason for you not to get the loan. The buyer not having leased or sold other real property unless such a contingency is expressed in the agreement. So if you did not put a buy or lease contingency in the purchase and sale agreement, that's not a reason for you to be denied the loan. Okay. Buyer not having provided the lender in a timely fashion all of the information required, such but not limited to loan documents, official wood infestation report, structural letters, well tests, septic system certifications, floodplain certifications, and any other similar required reports that the lender hereafter collectively required information. All right, so if the lender has requested stuff from your buyer, it might be good that you have that conversation with the lender and find out what is needed. You know, this is why you have a great rapport with your lender or your buyer's lender, and you say, hey, you know what? What does Sally Sue need? Have you requested anything that she hasn't gotten? Let me make sure that she gets you all documentation. All right. D, the buyer making purchases that adversely affects the buyer's debt to income ratio. Womp womp. I know you're moving to Lake Lanier, but you got to wait till you get the house before you get the boat, right? We got to make sure that's a conversation, right? E, the property not appraising for at least the purchase price unless this agreement is subject to an appraisal contingency and an appraisal meeting the requirements of this agreement has been performed, right? We have been sticking in a whole bunch of crazy stipulations, right? Special stipulations saying, oh, we'll pay the difference. Well, that's great, but that is not a reason that you're not going to get the loan, right? just because it doesn't appraise and you're saying you'll pay the difference, you're not going to get a loan denial letter for that, all right? Or the lender not having completed underwriting the loan request. Just because the lender didn't finish on time doesn't mean you can get a loan denial letter and you get your earnest money back. So we need to make sure buyers understand this. Now, buyers may terminate this agreement without penalty based upon the inability to obtain the loan only if the buyer fulfills all of the applicable requirements set forth in this exhibit. So if the buyer has done everything that they're supposed to do and they are denied at no fault of their own. We had this happen during 2020 when COVID first hit, and a lot of the loan requirements changed because whether credit scores went, the minimum credit scores went up, the debt to income ratios changed. There was other factors that went into it, and a lot of people that had qualified prior then didn't qualify. That was not their fault. That was changes to the regulations within the lending community. They didn't qualify, therefore they were not penalized. They got a loan denial letter and were able to terminate their contracts. Okay? All right. Exciting stuff. All right, so we are now down to number 9. This is a fun, contentious subject quite a bit when we're talking about buyers and sellers. Number 7 is the right of the seller to request evidence of a buyer's ability to close. And we have had this recently in our office about what this means and what it actually says. So let's talk about that. Okay. If the financing contingency ends without the buyer terminating this agreement, which is what we all hope, the seller shall have the right, but not the obligation, to request that the buyer provide seller with written evidence of the buyer's financial ability to purchase the property, which is considered evidence. A copy of a loan commitment from each institutional mortgage lender from whom the buyer is seeking mortgage financing to purchase the property, stating the type, amount, and terms of the loan and the condition for the funding of the loan shall be deemed sufficient evidence, which is very much like a pre-approval letter again, okay? Because what a loan commitment letter is from the lender stating they are getting a conventional loan for 30 years at 2.9%, whatever, with an APR of this, funding this, and that from the lender would be considered evidence that they have the ability to close. The provision of such evidence is not a guarantee that the mortgage loan will be funded or that the buyer will close on the purchase of the property. The buyer shall have 7 days from the date the seller delivers notice to the buyer requesting the evidence to produce the same. No request for such evidence shall be made by the seller less than 7 days from the date of closing. Okay, so this lets you know you as the buyer's agent can request of the listing agent, right, after the financing contingency is over, hey, you know what? Can we please have evidence from the lender of the buyer's ability to close? There you go. All right. Now, number 8 says the seller's right to terminate. Now, in the event the buyer fails to provide the seller with this evidence within the time frame set above, the seller shall notify the buyer of the default and give the buyer 3 days from the date of the delivery of the notice to cure the same. If the buyer does not timely cure this default, the seller may terminate this agreement within 7 days due to the buyer's default upon notice to the buyer. In the event the seller does not terminate this agreement within that time frame, the right to terminate shall be waived. Now understand, we don't utilize these because most of the time, as long as we're moving forward, most sellers and buyers don't even question. However, if your seller is concerned and you request evidence from the lender and the lender has given you the type, amount, and terms of the loan, the conditions for funding the loan, you have been given evidence of the buyer's ability to close. That's all you need, right? But take into account, if you have a concern, make sure you're requesting and going through the right channels that you did as a listing agent, what was required of you to protect your seller. All right. Number 9, authorize a buyer to release information to seller and brokers. The buyer does. Now, this doesn't say they can question, they can change. It states the buyer does hereby authorize the seller and the brokers identified herein to communicate with the lenders with whom the buyer is working. Did you guys know that that's in there? Did your buyer and seller know that that's in there? By signing any loan exhibit, that phrase is in there. So I'm going to read it again. The buyer does hereby authorize the seller and the brokers identified herein to communicate with the lenders with whom the buyer is working, to determine and receive from said lenders any or all of the following information. A, the status of the loan. B, buyer's financial ability to obtain the loan or other loans for which the buyer has applied. C, whether and when the buyer provided the lender with required information. D, whether and what conditions may remain to complete the loan process and to issue a loan commitment. And E, the basis for any loan denial letter. Kind of shocking, huh? It's right there in black and white. Everybody signs it. The buyer is authorizing that not only you as a buyer's agent, but the seller, as a seller, can pick up the phone, and the listing agent, as well as their brokers, can call and ask those specific 5 items to the lenders. We need to be having this conversation more with our customers and clients. Okay? Now, I skipped miscellaneous because this is just for the purpose of the exhibit. The term mortgage loans shall refer to securing lending transactions. I think we kind of all understand that. So let's talk about the elephant in the room, which is number 11, the appraisal contingency. Now, I'm going to read this because I would like for us to specifically understand all the different dates, because a lot of agents confuse this and have been confused with how this works. And I'm going through the conventional exhibit first because it's the only one that you have to request additional days if the loan does, or if the property does not appraise. With an FHA, VA, or USDA loan, if the property doesn't appraise, the buyer can walk away. That's not true with a conventional loan. So let's see what it says. in addition to the buyer's rights herein. This agreement shall be subject to the following appraisal contingency. The buyer shall cause the lender to A, select an appraiser to perform one or more appraisals on the property, and B, provide the seller with a copy of any appraisal that is for less than the purchase price of the property. Stop. What did that just say? Did it say I need to ask my buyer if I can give a copy of the appraisal to the seller? No. It says provide the seller with a copy of any appraisal that is for less than the purchase price of the property. Here again, the buyer is signing an approval that if the property doesn't appraise, you're giving a copy of that appraisal to the seller. Okay? It's in black and white. If such appraisal is for less than the purchase price, the buyer shall not later than blank days from binding agreement date have the right to request the seller to reduce the sales price of the property to a price not less than the appraised price by submitting an amendment to the sales price to the seller along with a copy of the appraisal supporting the lower price. Here's where agents get confused. When they see appraisal contingency and they see that blank, they put days in there that they think they need to have for the appraisal to happen. That line is not for days for the appraisal to happen. That line is for the buyer to request the seller reduce the sales price. So understand, from the binding agreement date, you're asking for a certain number of days for the buyer to have to reduce the sales price. So you may ask your lender, hey, how long is it going to take for me to get an appraisal? And your lender may say 15 days. Well, that's fantastic. So you can put 15 days in there, but what happens if the appraisal happens on day 14? And you don't get it back to day 16. You've already lost your chance to request an amendment to the sales price. The appraisal contingency is not about the actual appraisal. The appraisal contingency is the right to request that the seller reduce the sales price to a price not less than the appraised price of the property. So when you go into using an appraisal contingency, think about those days more than when the appraisal is going to happen. Now, let's read the next sentence. In the event that the buyer does not timely submit the amendment to the sales price to the seller, the buyer shall deem to have waived that right, and this agreement shall no longer be subject to the appraisal contingency. So you missed that cutoff day, you're paying whatever the purchase price is, regardless of the appraisal. Ouch. This is why it's super important to know your days. Okay? Now, the next paragraph gets very confusing. The seller shall have, the seller shall not later than 3 days from the date of the amendment to the sales price, but not later than 2 days prior to closing, to accept or reject the amendment to the sales price or to seek to negotiate with the buyer a lesser reduction in the sales price of the property than what is reflected in the amendment to the sales price. So, and I'm going to use days of the week. So on Monday, you submit to the seller an amendment to the sales price. So he has Tuesday, Wednesday, and Thursday to respond to you as long as closing doesn't happen on Thursday. Okay? Now, he can respond and say yes. He can say, no, I'm not going to reduce the sales price, or he can look to negotiate with the buyer by Thursday. Okay? If within that time frame an amendment to the sales price has not been signed and accepted by the buyer and seller, so by Thursday, and timely delivered to create a legally enforceable amendment, the buyer shall have 3 days. So now the buyer has Friday, Saturday, and Sunday, but not later than 1 day prior to closing. So as long as closing doesn't happen on Saturday or Friday, to terminate the agreement without penalty. So now pretty much we've gone a whole nother week. If the buyer doesn't terminate the agreement within this time frame, the buyer's right to terminate due to the failure to agree to the amendment to the sales price shall be waived, and the buyer shall close on the property for the purchase price set forth in this agreement. Nothing herein shall require the buyer to seek a reduction in the sales price. So now understand, if you submit on Monday an amendment to reduce the sales price because of an appraisal, and the seller doesn't do anything or respond by Thursday, you have until the next Sunday to terminate the agreement or to do something, or you are now required to purchase the property at the agreed upon purchase price. This is why it is detrimental for you as a buyer's agent to, number one, be on top of all of your dates and know exactly when your appraisal contingency, your financing contingency, and your timelines are. This is also why it's critical for you as a listing agent to make sure that your seller understands he can't play around. Because he could lose a deal because he didn't answer. Because you miss things and don't agree to things or overlook things, buyers will terminate so they don't get stuck purchasing a property they don't want. Okay? So this appraisal contingency is not just about making sure a house appraises. Appraisal contingency also protects the buyer and the seller from ensuring that they don't get wrapped up in something that they don't wish to purchase. But the great thing is, in the way that it reads, it protects the buyer and it protects the seller. So does this entire agreement, which is fantastic. I mean, think about it, guys. How great is it that you have this option to both have the buyer and the seller protected almost equally in one agreement, which is pretty fantastic, right? All right. So I haven't seen that too many of you have any questions. So I'm thinking that everybody's pretty clear on this. All right. So now, of course, with a financing contingency of all, whether the buyer or the seller, you have to know what you're doing with the exhibit. It's pretty important. To create an enforceable, understandable, and clear contract, financing contingency exhibits are fantastic because they really spell out for buyer and seller what needs to be done. Right? So I'm going to now show you a form, if I can, and I'm going to say that I can. Let's see if I can. Let me see. Well, actually, I guess the one good thing that it allows me to do this, hold on. I'm going to pull a form in here that I'm hoping you guys will be able to see. Maybe it'll let you see it. It is called a reminder of important dates. Now, I don't know, it's probably